Markets are ripping. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
Coming up, the Besant trade. Markets are betting the Wall Street veteran will be able to force stability inside Trump's administration. And we have shocking news from Macy's, the retailer delaying its earnings report after an employee hid over $100 million in expenses. Plus, Amazon is working on one of the tech industry's most ambitious moonshots, loosening NVIDIA's grip on the market for AI chips. So a lot to talk about on this Monday morning, a shortened week of trading, but it could be a big one, folks. Let's take a look at where the markets are trading. S&P futures up 0.2%, NASDAQ futures up just about the same. And I say that markets are ripping because we're excited about the Goldman Sachs note, Katie, that we could see a 4% gain this week on the S&P 500.
Well, it will start this week, theoretically, and then rally through year end. We'll see if that materializes. Right now, though, if we take a look at the individual stock level, we have to start with Macy's. Of course, it's delaying its third quarter results after an employee hid tens of millions of dollars of expenses. You can see shares currently down a little bit more than 1%. They had been down mightily right now. We'll talk about the fallout of all of that. But let's also talk about Bath and Body Works. It's surging after boosting its earnings per share forecast for the full year. You can see shares surging as well, up more than 20% pre-market. And then finally, we have Rocket Labs, also higher. This is after the satellite company said it successfully launched its 56th Electron missile, Matt. That is good for almost 11% rally pre-market.
All right. That's a big deal, adding 11%, well, pre-market, right? But we'll see if it happens in the cash trade. The big deal this morning, the story that caught our collective eye, was an earnings report from Macy's delayed because one employee hid over $100 million in shipping expenses. Why? And where were they hidden? We have so many questions, and we're joined by Bloomberg's Emily Cohen here on set to talk about it. So let's just get the basic facts that we know for sure. Macy's said no earnings report today, no call today, telling us with very short notice because what happened?
Well, we know one employee, and they say it was limited to one employee, hid more than $100 million in expenses. The employee made erroneous accounting errors to hide delivery expenses over multiple years. We know Macy's shares fell dramatically when the news first came out, about 8.2%, but losses have paired since then when it became clear that the financial impact of this is pretty minimal. But the company did announce preliminary earnings today, showing a 1.3% drop in comp sales, which is slightly better than analysts had predicted. And hopefully we will learn more when they release their full earnings by early December, they said.
Yeah, so the results that they did release slightly better than expected, but then you compare it to Bloomingdale's, for example. They saw comp sales rise by 3.2%. But let's go back, of course, to this scandal. I think it's safe to call it a scandal.
I think so. $154 million in expenses.
That is a lot of dollars.
Yeah.
And we have a little bit of information, but what don't we know? What is the priority over at the desk right now?
So we are wondering a lot of things. First of all, how did Macy's miss this? I think it's going back to 2021. So that's many years, many quarterly reports where this money presumably wasn't accounted for. How was it missed? Also, where did all the money go? We don't know where that money went at this point. And then more generally about the company, what will its earnings tell us? An interesting thing about this investigation is it'll delay its earnings report until probably after the Thanksgiving holiday, after Black Friday. So that report might tell us a little bit more about the American consumer, the American shopper. Macy's is a place mass market American consumers shop. So anything it can tell us about how the holiday shopping season is going so far will be interesting to watch.
I can't believe Bath and Body Works has a bigger market cap than Macy's.
That's pretty amazing.
I would think Macy's is like the main American shopping center. Maybe I only think that because Bloomingdale's is right across the street, you know, and Macy's at Herald Square is like an American icon, but the business isn't as big as maybe one would think.
Yeah, and it has a lot of work to do.
Yeah, it certainly does. Emily, great reporting as always. That is Bloomberg's Emily Cohn. And just to go over the timeline again, Matt, I find this really interesting. So this went on from the fourth quarter of 2021 through the fiscal quarter ended November 2nd, 2024. Of course, we're learning about this now. I can't imagine what it felt like, of course, in the C-suite when they uncovered this, what the fallout must have been.
Yeah, I think it had to be pretty shocking. It sounds like they may have uncovered it over time, right? Because the employee's already been fired. So it's not like they found out last night and fired the employee this morning. By the way, they had net sales of $4.74 billion. That was just off what was expected, $4.75 billion, but it is less than their market cap. So net sales for one quarter is bigger than the market cap, $4.5 billion.
Yeah, it's pretty amazing, of course, and it's interesting that we got at least some numbers today. To Emily's point, maybe now we'll get a little bit more detail about what Black Friday actually resulted in when they do report earnings. But you were talking about how big they are. It's the largest U.S. department store chain by revenue, so your gut instinct was right. Macy's is super big, but smaller than Bath & Body Works.
All right, let's broaden out the conversation with Liz Young-Thomas, SoFi's head of investment strategy. And Liz, while we're talking about the consumer, let's just get your thoughts on how the American consumer is doing. I mean, Black Friday, is it as big of a deal? Isn't it pretty much a whole month now? What do you think?
Well, it does seem like Black Friday lasts at least a week. I started getting emails about Black Friday sales last weekend. So there are certainly promotions that go on. A lot of times during this point in the year, we start to speculate about the deals that are happening. Are there more deals happening? Are there deeper discounts going on? So far, and this is just anecdotal, but so far just as a consumer, it seems pretty normal to me. But I'm guessing that we'll start to hear that commentary pick up, that retailers either are or aren't discounting things more so than in normal years in order to try to move inventory. I think the big question about the consumer has not been whether or not the consumer is spending. We know the consumer is spending. The consumer has held up reasonably well, considering everything that had gone on with inflation over the last few years, and the spending has continued, but perhaps some of the tastes have changed or the patterns have changed. So the big question for retailers, and that we have to listen to in results from these companies, is whether or not they've managed their inventories properly to adjust for those changes in consumer behavior.
Yeah, you're absolutely right. And we've seen inventories be a big issue in some of the other reports from the retail segment that we've already gotten. But let's broaden out to the broader index. Of course, one of the most read stories on the terminal right now is this call from Goldman that we're setting up for a year-end rally that could begin this week, that could culminate in 4% gains through now and the end of the year. When you think about where we are in markets, what we know and what we don't know at this point, do you think that a 4% gain through year-end seems reasonable?
Well, Katie, we're on our second year of over 20% in the S&P, so honestly, anything seems reasonable at this point. And we've got a lot of wind at our backs since the election, and obviously there was this big run-up in the market since the election, and then there was a little bit of a letting off of steam. Maybe we got a little ahead of ourselves, and I do think that there needed to be some rationalization of that immediate aftermath rally, because we still don't know exactly what the policies will be in 2025. We don't know about all of these announced nominees actually getting through. So there are still a lot of questions to be answered. But then obviously the announcement with the Treasury Secretary over the weekend is another boost of wind at Wall Street's backs because of his background. So I do think that it's possible that this rally continues through the end of the year. And I do think that there is still a lot of enthusiasm, not just continuing in the tech space, but obviously broadening out into other sectors, looking at cyclicality, expecting stronger growth in 2025 than we were before. I think the big thing that we have to pay attention to is that at the beginning of this year, you have to ask yourself, what's changed since the beginning of this year? What will be different in 2025? Obviously, a new administration. So the expectation of lower regulations and everything that we've been talking about for the last few weeks. But the other big thing that's changed is we have to remember in the beginning of this year, we were expecting 6 Fed cuts this year. It looks like we're about to get only 4. And then now the market is only pricing in another 2 for the entirety of 2025. So we have to do this in an environment where we're not going to have quite as much monetary loosening at our backs as another tailwind.
Does that matter, Liz? I mean, especially if the market's going to be powered by mega cap chip makers and hyperscalers. I mean, if that's the case, we don't really need rate cuts. On the other hand, if you're rotating into small caps, you probably do want rate cuts, right?
Well, so your question about if the market's going to be powered by chips and all of these hyperscalers, I don't know that that's the case in 2025. We've already seen a lot of the wind sort of come out of those sails, and those companies have done okay, but they haven't really been the big leaders of late. So that trend could continue into 2025, where you need a lot of other sectors and even other parts of technology, like the software space, to take over in 2025 and drive the markets higher. Now, it would take a lot for them to take over for the amount that those big tech names have already driven markets up. So I don't think we're going to get commensurate returns in 2025 like we've seen in 2024 and even in 2023. But we can find strength in other places. And yes, I do think the Fed cuts matter. But the last part of your question about small caps is really a matter of what do yields do in response? And we've seen this big rise in yields, the 10-year and the 2-year, but now we've got this yield curve that's pretty flat again. But we've seen this big rise in yields, which we know pressures small caps. So far, the market at large, including large caps, has been fine with this rise in yields. But there seems to be a mental threshold right around 4.5% on the 10-year, where the market doesn't like it anymore. And it starts to get nervous that yields are going up for the wrong reasons,
Right.
Things like inflation reigniting, deficits, so on and so forth. So I think we need to stay in a reasonable range for yields.
You make a great point, Liz, that you think about what the Fed has delivered, 75 basis points worth of cuts. It doesn't matter for the long end. The long end is doing what the long end does. And you do have that yield curve inverted once more, at least briefly this morning. But that brings me to my next question, which is when you're thinking about the small caps, the relationship with the bond market, what part of the yield curve should we be paying attention to? Is it the short end or is it longer out the curve?
Well, it depends on what the financing period is for a lot of those companies. So if you look at just corporate financing, a lot of times corporate bonds are somewhere between 5 and 7 years in maturity. So that's what we would consider the belly of the curve, or that sort of medium term between 5 and 10 years. The 10-year portion of the curve usually reflects what we think about the economy in the future. So is growth going to be strong? Is inflation going to stay anchored? So that 10-year portion, as you mentioned, is sort of operating on its own accord. The 2-year portion of the curve, which is believed to follow what we expect the Fed to do most closely, is likely what's going to affect small caps on a daily and weekly and monthly basis when you see fluctuations in the 2-year portion of the curve and shorter.
All right, Liz, always great to speak with you. Great to kick off the week with you as well. That is Liz Young-Thomas of SoFi. Meanwhile, let's get a check on these markets right now. Less than 20 minutes until the bells ring. You can see we have a rally and then some on our hands. The S&P 500 up about 0.8% pre-market. It just gets better from there. Your NASDAQ 100 up about 0.9%. And it's the small caps claiming victory so far this morning, up 1.3%. Loving the bid that we're seeing in the bond market this morning. Now coming up, President-elect Trump's hunt for his cabinet members comes to an end. More on that next. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Blackstone is agreeing to invest $3.5 billion to create a joint venture with EQT. The transaction will enable the U.S. natural gas giant to reduce its debt. The deal sets up a rivalry between Blackstone and Apollo as both firms push further into the corners of the market that have been long dominated by traditional banks and bond markets. And Scott Bessent, the hedge fund boss who's been picked to lead the Treasury Department in President-elect Donald Trump's next administration, has 2 words for you: economic lollapalooza. The Key Square CEO sees a coming global economic reordering, and he has wanted to be a part of it, obviously. A Connecticut couple is being is taking part in an organized retail theft ring that is alleged to have stolen about $1 million in Lululemon merchandise across several states. After their arrest, police found a dozen suitcases with $50,000 worth of attire in their hotel room, tags still attached. But let's turn back now to the politics story. Trump finally picks his Treasury Secretary. It was on Friday evening. Scott Bessent joining us now is Anne-Marie Horder, Bloomberg's chief political correspondent and co-host of Surveillance. So, Anne-Marie, the markets seem to be breathing a sigh of relief. This is somehow letting some steam out of the dollar, although Bessent had just written an op-ed about how Trump policies were going to boost the dollar, or did.
Yeah, I think you do see what the market is welcoming as someone who cares about fiscal spending and cares about the deficit in the United States, which you don't always hear when you hear about a ton of policies which are calling for tax cuts and higher tariffs. This is someone who actually cares about getting the deficit down. He's talked about this idea of 3 arrows, cut the deficit by 3% of GDP by 2028. Likely that might not be possible if you look at how much spending we have for things like Social Security and Medicare. He wants to unleash the equivalent of 3 million barrels of oil when it comes to energy, to have this pro-growth environment, which he says then with deregulation would boost GDP. So this is where his head is. I think the markets are also welcoming the idea this is someone who has a deep understanding of how global financial markets work and actually made money looking at micro data and how that potentially would play out 6, 12 months down the line. Alongside Stanley Druckenmiller and George Soros, this is an individual, even though George Soros gets all of the love for this trade, breaking the Bank of England, it was Scott Bessent that did all the work about the housing crisis going on in England that led to that trade.
What an amazing career path, by the way.
Incredible.
You work for George Soros, and then you work for Donald Trump.
Well, Neil Dutta put it best when he said it takes a certain type of personality to both manage the individuals of George Soros and Donald Trump. And this is why I think the market is breathing a sigh of relief. It is someone who understands financial markets, going to be at the helm of Treasury. Potentially his one hurdle, of course, is going to be Washington speak and just how slow Washington moves compared to financial markets.
Yeah, Neil Dutta, of course, had some passionate notes last week. Have to imagine that he's happy with this Bessent pick. But let's talk about some of the policies, because some of them seem contradictory. You talk about this focus on the deficit. He said, though, that his first priority will to deliver on Trump's tax cut pledges. So how do those two sort of cancel out there? How do you offset the two?
Well, they're going to have pay-fors. And a lot of Republicans in Congress, we know that Republicans have a sweep across the board when it comes to the House, the Senate, and the executive branch. So we are going to see Trump's plans likely get enacted, but there's going to be serious fiscal hawks who want to see the pay-fors and not all of these promises on the campaign trail when it comes to taxes. There's a slew of tax promises they promised. No tax on tips, the idea of no taxing on Social Security, expanding the child tax credit. There were
auto loan interest deductions.
There were so many of these promises. Not all of them are going to be policy, and part of that is going to be where the pay-fors are going to be. So I think when someone that says we're going to reduce the deficit, maybe not spend as much as the trajectory we're on, but also there's going to be a lot of Republicans in Congress that say if we're going to enact or even extend the TCJA, the 2017 Donald tax cuts, they want to see the pay-fors for that. And that's when tariffs come into place, because they've talked about tariffs being the fiscal driver to bring money in to make those offsets.
It's the growth part of the 3-3-3 plan, right? He wants to, have fiscal deficits be 3% of GDP. He wants to ensure 3% growth, and we're running now about 1% below that. And then what's the third three?
Oil. Energy.
Yeah,
oil, 3 million barrels a day extra.
Equivalent.
Right?
Equivalent. So maybe it's not oil, but it's energy equivalent.
So many things that are outside of his remit as Treasury Secretary. It just isn't clear to me how he's going to make all these things happen.
Well, a lot is also unclear because it also depends on who President-elect Trump puts in at USTR, the individual who is going to really enact the 301 tariffs when it comes to, say, tariffs on China. We know Howard Lutnick will be at Commerce. They're in charge of the 232. His press release when he was announced made it seem that USTR would also basically report into him. But Terry Haynes talks about this cast of rivals, a cabinet of rivals. And if you have someone like Scott Bessent who's come out and said tariffs are going to be a negotiating tool, maybe it's you get to 60% 2 years and you do 2.5 every month. Xi Jinping tell us when it bites to try to get back into what they would call free and fair trade, or is it going to be blanket tariffs? And I think until we have the full picture of who's in the cabinet, it's going to be difficult at this moment for the market to really digest and understand what policies are going to be the ones that they emphasize first out of the gate.
Well, at least for right now, markets seem to be embracing the picks that we've gotten so far. The 10-year Treasury yield falling below 4.30. Anne-Marie Hordern, great to see you. That is our chief political correspondent and the co-host of Surveillance. Now, coming up, RBC strategist Lori Calvasino weighs in on Trump's Treasury pick. She sees the S&P 500 at 6,600 by the end of 2025. This is Bloomberg. All right, welcome back to Bloomberg Open Interest. Let's get you a check on futures right now, and it looks pretty good. The S&P 500 currently up about 0.7%. Big tech, even better. The NASDAQ 100 up about 0.9%. But the star of the show right now is your small cap index. The Russell 2000 up about 1.2%, helped by what we're seeing in the long end of the Treasury curve. 10-year yields down 10 basis points below 430 at one point, of course, giving a bid to those smaller companies. Then you take a look at Intel. This is interesting. We have some breaking news from CNBC that Intel and the Commerce Department are close to finalizing roughly $8 billion grant for the chip maker that should help support their chip manufacturing expansion. You think about what companies really need money right now. Intel is pretty close to the top of the list, Matt.
Yeah, I mean, anybody trying to challenge NVIDIA, and we have a great big take on Amazon trying to do just that, really needs a lot of money, or anyone building a large language model. I think it's interesting that you have a re-inversion of the Treasury curve. You mentioned the 10-year at 430 or under 430, and it still is. The 2-year is over 430.
There you go. A lot of Fed expectations in the front end. What's going on in the long end? Bond investors are thrilled about Scott Bessent. Coming up, we'll talk about all of that and more with Lori Calvasino. She joins us at the Market Open.
We are moments away from the start of trading, kicking off this week with futures in the green. I'm Matt Miller. Welcome to Bloomberg Open Interest. We're looking at a 0.7% gain on S&P futures this morning, 0.8% gain on NASDAQ futures, Russell futures even higher on optimism that Scott Bessent as Trump's Treasury pick will bring some stability to policy and thus the economy and the market. You hear the opening bell ringing on the New York Stock Exchange, Global Ship Lease ringing it there. Over the past 5 years, that company's stock has tripled. But it's all about the window. If you've invested over 10 years, you've earned zero money, even with reinvested dividends. Here, you've got a SPAC, YHN Acquisition Limited, ringing the bell at the NASDAQ. They just started trading, and they haven't really changed in terms of the share price. In terms of the major averages, they will be changing. They will be going up this morning. And Goldman Sachs' Scott Robner says we could see a rally into the end of the year. 4% gain, 6,200 is their target.
At least for right now, the market is agreeing with them because you can see the lines, the arrows are pointed higher. The S&P 500 up about 0.6%. We were higher pre-market, but we'll see what happens. Same thing, too, if you take a look at the NASDAQ 100, big tech up about 0.6%. Double that if you take a look at the small caps. The Russell 2000 is your leader at the moment, up about 1.2%. This comes back to what we're seeing in the bond market, that bid coming into the long end of the Treasury curve, helping to support small caps right now. We'll see how long that is sustainable. But let's take a look under the surface because we do have some individual movers, and we start with Bath & Body Works. It's jumping higher after beating earnings expectations. It also raised its sales outlook for the year. That is good for an 18% pop at the open. But we're also keeping an eye on Intel here, jumping on a report that it's close to finalizing a roughly $8 billion grant from the Commerce Department, a grant, of course, that Intel pretty sorely needs, of about 1.5% so far, Matt.
All right. Finally, Macy's delaying third quarter results after an investigation revealed an employee hid up to $154 million in expenses. For a closer look at Macy's stock, let's go to Bloomberg's Abigail Doolittle. Abby?
Well, it is really pretty extraordinary that the stock on these headlines only down 3%. This probably has to do with the fact that it did not hit their cash management issues or their cash management period or vendors. In terms of what happened, an ex-employee basically made intentional accounting errors around starting back in 2021 that equal up to $154 million. This employee did work in the small package delivery expense accounting. But again, Macy's is saying when they were putting together the earnings, that was supposed to happen, but is now delayed until December 11th. They found this error, but did not hit cash management practices or vendor payments to what they can tell. As for Macy's, let's take a look at what the real heart of the story here is, because this company's been struggling. Same store sales, well, they are really in a slump. If we go into the Bloomberg terminal, we're going to see quite a bit of red here. Now, back in 2021, actually, when those accounting errors, those intentional accounting errors were made, you can see lots of green. But basically, since the third quarter of 2022, for the most part here, lots of red. So this is the real thing that Macy's has got to do, get these same-store sales boosted in the right direction, Katie.
Yeah, an incredible scandal later on top of some pretty weak fundamentals. Macy's shares down about 22% year to date, including today's loss. We'll have to continue to follow that story. But let's broaden out the conversation right now, because sitting to my left is Lori Calvasina. She is RBC's head of U.S. equity strategy, and she sees the S&P 500 rising to 6,600 by the end of 2025, just introducing that target. And Lori, it's interesting because you take a look at where Wall Street is right now, the sell-side community. It seems like that number is pretty much the level that everyone's decided on. Talk us through the math that gets there, because I think that's about a 12% gain.
Yeah, I think it's maybe about 11% versus Friday's close. I had to keep repricing this as I was writing it and editing. Look, I think there is a reason why we're all sort of clumping around the same number. And I'll be honest with you, I don't like being where everybody else is. So we actually gave this quite a bit of thought, and that's just where the math leads us. And at this point in time, I think that there is a little bit of fog in the outlook regarding the economy specifically. And just to give you a sense of my math, I have 5 different models that contribute to that 6,600. That's basically the median, and I have 2 models that are right in line with that. But one of my tests is the economic test, and it's just how do stocks do in different GDP environments. And guess what? 1 to 2% GDP tends to see a decline of more than 3%. It's a very mixed environment. You're only up about 40% of the time, and that's where the consensus is right now. But it's actually acting like it's trying to move out of that. So literally, the consensus is at 2% right now. And if you look at 2.1 to 3%, that's quite a strong environment for stocks, where we're up about 11% on average, and you're up most of the time. And so
we're on the cusp.
We're on the cusp, and right, it could turn lower, right? And I think economists, I'm not an economist, thank goodness, but like I think economists are sort of struggling with how strong the economy is going to be next year. And I keep, if I think back the last couple months, they keep talking about slowing growth, all these headwinds. And as a strategist, I keep saying, well, we keep being too pessimistic, and we keep having to dial up the expectation. So I'm leaning in that direction, but admittedly, it's a very tough call.
Well, I mean, if you believe that we're going back to the business of business, as Ken Griffin said about the next Trump administration, if you believe that the tax cuts will get a continuation and maybe even more will be added in, it's got to be animal spirits driving the economy higher than 2% GDP growth.
Right, and so we're giving the market the benefit of the doubt on that we're going to be able to get over that hump. We don't know exactly how strong, but we bet we're going to be able to add, a little bit more.
Not to mention, Lori, by the way, the spending on AI is looking very real. And the expectations are for CapEx of, what, $2 trillion, I'm sorry, in the next 5 years. That's from Moody's. Even if that's aggressive.
Right. I think that the issue with the AI trade, right, is not that it isn't real. I do think, as my team and I sort of, say amongst ourselves, and we've written this in our weeklies as well, it does seem like some of the examples from the end customers are kind of small potatoes or underwhelming so far. So I think there's a little bit of, maybe dampening of enthusiasm in the short term. How additive is this going to be to broader corporate profitability in terms of those end results? But I do think it's real. I do think you also, though, have, those mega cap growth names, a lot of them AI centric, right, have seen these phenomenal growth rates, and those are just decelerating. So that causes some indigestion. But to go back to your comment, Matt, on the animal spirits, I think that's something else that's a little bit of a struggle right now. If you look at the CFTC data on U.S. equity futures positioning, we are hitting new all-time highs. And if you look at Russell 2000 specifically, which is a proxy for the animal spirits on the Trump trade, we came into the election at the levels we had seen back in 2016, 2017, and 2018. Right. And so there is a lot of good news already baked in. And if we go back to my FOG comment, I think even on the policy side, we know there are some tailwinds. Those tailwinds are well understood in terms of regulation, animal spirits, status quo, maybe a little bit more on taxes down the road. It's going to take some time to figure that out. But how expansive are those tax cuts going to be? Is it going to be for every corporation or just domestic producers? And then what about the tariffs? And I know we got the Treasury pick today, and I think that's a great market tailwind. I think that's a really good pick for the market. Right. But we still don't have clarity on exactly what this tariff policy is going to look like.
There's a lot to dig into there. I do want to talk a little bit more about the AI trade itself, though, because Matt and I are actually talking this morning that you take a look at the Philadelphia Semiconductor Index, it's only up 19-20% year to date, which I found kind of shocking because we talk about NVIDIA all the time. But are we seeing that broader participation in the AI trade, or is it NVIDIA basically carrying everyone on their back?
So I think a lot of it is just, kind of the biggest movers dragging everyone else along. And I'll say I have been keeping a close eye on the semis, and they've actually, if you look at the median PE multiple relative to the broader market, that median PE has been a little bit elevated, and you've had negative earnings revisions. And so it actually has been, sort of one of the more problematic areas of the tech space. And I've been neutral on tech, and so we've been watching it, really trying to get a sense of when is going to be a time to move back to an overweight. And that semi industry is just not cooperating on my model right now.
I also do want to get into tariffs because we've had a lot of retail CEOs on the show in the past couple of weeks, including the CEO of Brooks, including the CEO of Shark Ninja just last week, who were saying that the impact of these tariffs, launching all of those products. I'm waiting for the Shark Ninja car, but they're telling us that these tariffs are a real issue, that basically you think about how it's just too expensive to produce in the U.S., so someone is going to have to eat the cost. How are you modeling that in?
So, we're not baking it in right now, is the honest answer. We did spend a lot of time in our outlook that we put out this morning talking about the bear case, and one of the things we put in for our political test was the stock market performance in 2018, which was the only down year of the Trump presidency. We lost like 20% peak to trough. The whole year was only down about 6%. There was other stuff going on as well as the Fed. But, in our sector discussions, we've really been reminding people, things like industrials, materials, some of the areas people have wanted to play on Trump optimism recently, they got hit very, very hard. I'll tell you, Katie, the other thing, though, that I'm really concerned about in this tariff discussion, and I'll admit to you, I haven't really done a lot of reading over the last week, but that first week and a half after the election, I read everything I could get my hands on from company conference transcripts, earnings call transcripts, and I looked really close at the tariff commentary. Most of the companies are trying to reassure investors and say, hey, look back at the China trade war. We managed through that. We've diversified our supply chain. I can't tell you how many quotes I read where companies said we only have X% in China now. But I don't think that's what we're talking about this time. If you're tariffing everything and it's too expensive to produce here, at least in the short term, and by the way, it takes time to readjust supply chains, that is going to be a problem if these are really broad-based. And that's not what we went through before.
I will tell you that, have you used the ECAN function on the Bloomberg terminal, ECAN Go?
That is paid by mention,
but I'm gonna. I can give you like my 5 favorites, but not. I haven't tried that.
I will
yet.
just tell you that we now have ECAN functionality that allows you to graph how many mentions of a subject, for example, tariffs is one of them, are brought up on an earnings call, and then you can break it down into industry. So you could see, so Katie could see like running shoes, how many running shoes CEOs are talking tariffs. By the way, the S&P 500 has just hit a new intraday record. So we're climbing to heights that we've never seen before. And Scott Rubner at Goldman Sachs said he's put in an order for his SPX 7000 hat. Think we see that next year?
I don't know. I'd be curious to know what David Kostin says about that. But that, I thought his target was something like 6,500 or for next year or something like that. But look, I think, there are those of us who sort of live in the derivatives world, which I think he's from. I'm not familiar with him. But I will tell you, I always tease my own derivative strategist, Amy Wu Silverman, who's fantastic. And I always
She's amazing.
And I always say, Amy, like she lives in the tails. I can't live in the tails. I have to live in the base case. I have to live in what I can model. And, we certainly do know that, we woke up this morning and it felt like the animal spirits were back on. I think a week ago it didn't feel like that, so that's definitely a decent change.
Right.
But I will also tell you that I remember early 2018, and we had just come off that euphoria of tax reform in 2017, and the valuations were looking stretched, and the positioning was looking stretched, and then we ran into the low vol unwind, and then we ran into the China trade war, and we had an entire year where people were talking about how worried they were about the QT unwind and the Fed cuts having gone too far. So when you're at elevated positioning, when you run out of room on valuations, sometimes things break and it's not pleasant. So I would keep that in mind. That's the world I live in.
Good reminder.
It's a good place to leave it. I would love to be a fly on the wall for those robust discussions that you have with Amy, but we have to leave it there. That is Lori Calvasina of RBC Capital Markets. Now, coming up, Amazon is taking on NVIDIA in one of the tech industry's most ambitious moonshots. We'll have the details next. This is Bloomberg. Well, Amazon is going toe-to-toe with NVIDIA. It's building its own chip-making operation to turn data centers into giant AI machines in an attempt to reduce its reliance on NVIDIA. Joining us now for more is Caroline Hyde, the co-host of Bloomberg Technology. You think about what that would mean for NVIDIA. It's super bad because NVIDIA really relies on, it feels like just a handful of mega cap tech companies funneling billions of dollars at it.
And all of them are trying to make their own chips.
Yeah.
Microsoft's the latest to the party. They've only really started in the last year or so. Both Google and Amazon over the last decade have been trying to make internally their own chips for particularly artificial intelligence and machine learning. But many would say the point is supply so underruns demand that they love NVIDIA. This is a frenemy game. This isn't we will try to never be dependent on you. It's just they want to free up some of their NVIDIA bandwidth for some of the most integral AI work that they do for their clients so that they can depend on, for example, Inferentia and their own Trainium chips for their internal work more broadly.
It's fun to know that Amazon invented the cloud.
Yes, exactly.
So they kind of started this whole thing, and they don't have their own LLM. They don't have a Claude or what do you call Facebook's Iguana or
Llama.
Llama, exactly.
Pick an animal, any animal.
Or a Chat GPT. They don't have those things.
Yeah, they've been agnostic. It's kind of been a business model proposal of theirs. It's come to bedrock and choose whichever one is more fit for your purpose. We're not going to busy ourselves building the underlying large language model. We're just going to offer everyone else's. But they've got closer and closer into bed with, for example, Anthropic, which makes Claude. They just put in another $4 billion. That was announced on Friday. Why are they doing that? Well, they want Anthropic to use their own hardware and indeed therefore helped improve the software with the chips. So they want Anthropic to stress test and Databricks, another customer, to stress test the building of their chips, which are getting ever more sophisticated. So, for example, the likes of a Trainium 2 or indeed an Inferentia use these, make them better. We can then scale them internally.
So strings attached, basically.
Take our money, but use our compute and use our chips.
It's a fair ask, but we tease this as basically a very ambitious moonshot by Amazon. You think about Amazon dominating almost every industry.
They're quite good at moonshots.
Exactly. Where do we know about how far they are when it actually comes to this effort?
Well, I think at the moment as we say, about a decade in the making, and they have made purchases of chip startups that they have then internalized and build their chips on their own. This has been a moonshot in the making, but I think more broadly, this is now the third iteration, for example, of Trainium. This is where the rubber hits the road. Is this a sophisticated, powerful enough chip that not only offers you the hardware, energy efficient, cheaper to use, but also easily integrates in terms of software? Because that's where NVIDIA is so good. They are a one-stop shop. You don't need to particularly focus in and have to make sophisticated changes with your own engineering team to use an NVIDIA chip. Whereas Amazon at the moment isn't as easy to just plug and play. They need to get better and better at that so that people can adopt their chips more broadly.
But this is it. I mean, there was a great quote in the story about the 3-generation rule. Yeah. And the executive quoted said, "I've never seen anything go past." You know, it's the third generation, and it's a win, or it's the third generation and it's
and you're
done.
out.
Yeah.
And does this investment ultimately pay off? For now, they're hoping it does, and boy, have they just been throwing everything at it. For example, the Anthropic deal. And this is ultimately why they want to offer. They win cloud customers by having the chips that are more energy efficient and more cost efficient for them. And they don't want to be reliant on NVIDIA in case there is a Blackwell supply chain issue, in case they are having to like beg, borrow and steal for their own compute power. There is a race on at the moment, and how much better would it be if you were in control of your own supply side? And so that's certainly why Google's been doing it too.
Well, it's fascinating to watch it unfold. I know you'll be all over it on Bloomberg Technology. That is Bloomberg Technology's co-host Caroline Hyde. You can find more of Caroline at 11 a.m. Eastern. But coming up on this program, Citi has a new strategy to prevent its bankers in its wealth business from leaving. Talking about higher bonuses. We'll give you more details next in our Wall Street Beat. This is Bloomberg. Welcome back to Bloomberg Open Interest. Let's get a check of the stock market. 22 minutes into the session, you can see green on the screen and then some. The S&P 500, the NASDAQ 100 up by about 0.6%. But what an interesting and thrilling Monday this is, because you take a look at the Russell 2000 up by about 1.4%. You've seen some of the gains paired in the bigger indexes from where they were pre-market, but the Russell 2000 just gaining momentum here, Matt, up 1.4% on the small caps.
Yeah, these gains are fascinating, and the fact that we hit an all-time high.
That's cool, too.
In intraday terms, you know, I read the Rubner note, or Scott Rubner note.
Rubner, we should check on that.
I'll double check on the name, but I read it first, I thought, this week.
Yeah, that'd be huge.
6,200, but I guess the idea is this year.
Yeah, the year-end rally, according to Scott Rubner, is that this year-end rally will start this week, continue on to about 4% gains by the end of this year, and he put it out at a good time because markets agreeing with him so far.
And then he said, by the way, that continues into January, usually up until the inauguration, and then good years follow good years. So he he ordered an S&P 7,000 hat. All right, time now for Wall Street Beat. We are looking at how Citigroup is using bonuses to buy time as it undergoes a revamp of its wealth business. Bloomberg's Todd Gillespie joins us now with the scoop. So we love to hear about bonuses, and it's better if they're bigger. What's the story?
Totally. Bankers do as well. Yeah, I mean, basically, Citigroup now, as you know, going under a major revamp under CEO Jane Fraser. She's really made the wealth division a key pillar of this turnaround for the bank, which, as we know, has lagged Wall Street peers for years, since the financial crisis in particular, and has never really been able to find its footing. Particularly in the wealth business now, she's hired Andy Sieg, a very respected manager from Bank of America who ran Merrill Lynch there. He's now been forced to compete with varying interests, varying people leaving the bank. And also a lot of competition from a really ferocious industry where we know Morgan Stanley, Goldman Sachs, JP Morgan are heavily investing in their franchises as well.
So what is he going to do differently, though? Because this has been an ongoing story about the wealth business lagging. What's his plan to actually turn things around?
Yeah, it's a good question. I mean, Citi is really trying to lean into its Asia strategy in particular. It caters to a lot of these emerging billionaires, millionaires in countries like India and China. And it's now really trying to gain more and more wallet share from those kinds of clients, bring in those investment assets, and grow from there, grow that franchise that way. In its wealth at work business, it also caters to professional services firms like law firms, accountancy firms. It's also trying to expand that across, into Europe, into the Middle East potentially as well, and into Asia.
How do bonuses look? How does bonus season look in general? Is this a good year?
Bonus season in general, I think, is definitely a good year compared to the past couple of years for most people across Wall Street. Here we're talking largely about retention bonuses right now, which aren't quite the kind of bonuses the banks are going to want to be handing out right now. So yeah, we'll see. A lot of these people are going to be, well in their place into the new year. We always see a lot of, volatility on the market and movement around folks around that time. Yep. So we'll see how long this, how strongly this pans out for Citi.
All right. Great to have you on the show. Thanks so much for joining us today. Todd Gillespie from Bloomberg News, covering Citi, covering the bonus story for us. Coming up in the next hour, Paul Quincy joins us, JP Morgan Asset Management, and we have the CEO of H&R Block, Jeff Jones. I suspect we'll talk a little AI with Jeff, and maybe with Paul as well. This is Bloomberg. We're 30 minutes into the trading day and already hit a new record. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. And coming up, the best in trade, markets betting that the Wall Street veteran will be a force for stability inside Trump's administration. Also, shocking news from Macy's, the retailer delaying its earnings release after an employee hid millions of dollars in expenses. And the sluggish box office gets a boost thanks to moviegoers such as Matt. Wicked and Gladiator 2 raked in a combined $170 million over the weekend. We'll get into all that and more, but let's take a check on these markets right now because we're at new intraday records on the S&P 500, or at least we were. The S&P 500 up about 0.5%. The NASDAQ 100, something is underway because we were up close to 1%, but currently hanging on to gains of about 0.4% on your big tech names. And all the while, the bond market barrels on that bid coming into the long end. You can see 10-year Treasury yields now down by 11 basis points. We are below 430, which is pretty interesting because not too long ago we were knocking on the door of 4.5%. So quite a move underway in the bond market.
Little inversion there, right?
A little bit.
We have a 10-year yield that's lower than the 2-year yield, and it's still that way. Plus, Bitcoin is down.
Yeah.
It's weird, right? You'd think if we're risk on,
Animal spirits,
that it would drive it through 100,000, but it hasn't happened.
I'm starting to believe all the people who told me that the technical levels in Bitcoin right now, it's just really hard to break through 100K. But let's broaden out this conversation because we have a great guest, Paul Quincy. He is JP Morgan Asset Management's global head of equities. Paul, it's great to see you in person.
Thank you for having me. Happy Thanksgiving.
Happy Thanksgiving. Glad you could make some time for us. I'm not going to ask you about Bitcoin, but I do want to talk about where we are in this stock market. We're at intraday records on the S&P 500. You have the likes of Goldman saying that maybe there's another 4% to go through year end. What's the JP Morgan Asset Management view?
So to us, the fundamentals look pretty strong. That's the good news. So our analysts think earnings next year in the US grow by around 13%. That's a pretty good outcome. That's actually an acceleration from this year. And when we listen to those third quarter earnings reports, there's plenty of strength in this economy. We've got a boom in data centers, electrification. There's a ton of government programs going on. The consumer overall looks in pretty good shape. There's some softer spots, but overall looking in really good shape. So the momentum we've got going into next year looks terrific for us. The question, of course, is where to invest. Because with the S&P hitting record highs, we're now north of 22 times forward earnings. That's a level we've only really exceeded in history, at the end of the 1990s. So those fundamentals are really going to matter. And picking your spots in terms of valuation, I think, is super important right now.
So, I mean, if I were going to invest at this point, I would just buy an S&P 500 tracker and call it a day. Maybe an ETF, but the point is, does anything outperform the benchmark U.S. stock index?
I think we can do better than that. So, yes, I think from here, the broadening out, I think, is going to be the big theme. You've heard a lot of talk about it. You've seen signs of it in recent weeks. And we think it's on. So most importantly, fundamentally. So, look, the Magnificent Seven have that name for a reason. They have been absolutely exceptional companies. This year, you've got 30+% earnings growth from those companies, the rest of the market at 4%. Of course, they've outperformed. But as we look into next year, that gap starts to narrow. The Mag 7 starts to slow down, partly as they just get bigger, partly as they're weighed down a little bit by all of this investment in AI, and we'll see how that turns out. We're optimistic, but we need to see how that really plays out. Meanwhile, the rest of the market's kind of picking up. So that gap next year narrows from over 30% to somewhere in the low teens. So you've got fundamentals on your side in terms of broadening out, and then the valuations. Of course, there are high prices everywhere, but the valuations for mid cap, small cap, for the value side of the equation, they're all significantly less extended than we see in large cap growth. And I'd even say, don't forget about international.
Well, Matt and I try to very hard, actually. We had a whole discussion on Friday about how if you take a look at the U.S. stock market, it just beats everything over almost every time frame. So what's going to be different this time around when it comes to international? Why should we look?
So you're right. Fundamentally, the U.S. has been far superior. If you look at the last 15 years, U.S. has beaten Europe by about 7 percentage points a year. That's an enormous margin when you compound it over a 15-year period. About 4 percentage points of that comes from superior earnings growth. So that's a lot, but it's not all of it. The rest of it has come from U.S. stocks getting a higher and higher rating versus Europe, and they probably deserve a much higher rating. But at this point, that gap in valuations is now around 40%. We've never seen anything like it. So sentiment in Europe is terrible. It was bad anyway. I think Europeans have taken the election as another challenge that they have to deal with. You've obviously got geopolitical tensions right on the doorstep. There are all kinds of things to worry about. That's when you tend to get bargains. And I think particularly for the value part of your portfolio, and I think all investors should try to balance between value and growth, having some of that value in international value, where you can have a sensible portfolio on less than 10 times earnings and a nice dividend yield, that really is looking quite an interesting hedge to all of the excitement that we're seeing playing out on the screens with the S&P right here.
By the way, that's an important point, right? Because you're not talking about just buying the FTSE or buying the stock 600. You're talking about buying a curated portfolio that you've put together. And obviously, even though the U.S. is going to outperform on things like tech, there are areas where European companies do better, like luxury, for
Novo
example.
Nordisk,
No, that's right.
Yes.
There are some great companies, but there's also a lot of very cheap companies. And again, if you want to lean into that value part of your portfolio a little bit here, keep that balance. Obviously, you're going to have tons of money in the best stocks in the world, in the mag. Of course you are. But at the margin, putting incremental dollars to work in somewhere very different, I think it's pretty attractive right now.
Well, I'm curious to dig into how you treat valuations because, I mean, one of the mantras that's out there is that valuations are sort of a terrible tool to invest around. And you talk about these huge dislocations that we're seeing across the world, unprecedented in certain places. Does there need to be a catalyst? I mean, when do valuations really start to matter?
So you always start with the fundamentals. You can never get past that. And just buying things because they've gone down or the valuations look low, that's not good. That's not smart investing. But if you can find in the parts of the market that have been overlooked, stocks where there's upside in terms of forecasting, where there's room for positive surprises, and the starting point's really low, then that can really help you. In the short term, valuation's a terrible timing tool. In the long run, it really tends to make a difference.
Yeah, I mean, did you see Torsten Slok's note about how expensive U.S. stocks are? Over the weekend, he sent out it, like looking at the last 10 years and taking the earnings average of the last decade. But of course, stocks are a discounting mechanism. You want to be looking forward, don't you?
Exactly. You've got to be looking forward. Which is why I think the broadening makes a lot of sense. Looking forward into next year, you know, those exceptional stocks are perhaps just a little less exceptional than they've been.
Well, when we look into next year, we have to talk about what's going to happen at the end of January. Of course, Trump taking over office again. There's a lot of question marks around tariffs. We were just having this conversation with Lori Calvasina that you think about some of these retailers that we talk about and talk to all the time. It's a big headwind. And when you approach markets, when you approach your models and your forecasts, how do you take into account such an unknown?
Forecasting politics, we think, is not a great way to try and make money in the stock market. It's not just that the events themselves are quite unpredictable. Even when you know how an election's gone, figuring out how that's going to play out in terms of future returns, it's a very difficult thing to do. So, for example, in late 2016, there was a lot of talk around how big tech had got too powerful, how there'd be a tremendous amount of support for the energy sector. In the following 4 years, tech stocks returned almost 200%. The energy sector was down 40%. It was the worst place to be in the market. During the current administration, there's been a lot of support for new energy. It's been the absolute worst place to be in the stock market. Those stocks are down 50%, even as the S&P is hitting new highs every day. So, of course, politics matters, but you've got to look beyond that, and you've got to stay focused on the fundamentals, and that's really what we try to do.
All right, well, I think that's a good place to leave it. Paul, it's great to see you. Have a great Thanksgiving when you get there. That, of course, is Paul Quincy of JP Morgan Asset Management. A really interesting look at the stock market, talking about valuations. We talk about valuations all the time to hear the investor perspective of how you actually take that into account and make decisions with it.
Well, I think like everything else, it really depends on the metric that you use, right? You can look at valuations, and depending on the time period that you choose or the method, you can make a lot of things look good or bad. I think it's a great point that Paul made about politics. I mean, we spend so much time talking about what's going to happen with tariffs, what's going to happen with regulations, what's going to happen with taxes. But the truth is, no one knows. I mean, maybe we know a direction at best, but we have no idea about the details.
Yeah, a sobering, humbling thought. Maybe we should talk about stocks and what they're doing.
Let's do that. We did hit a new intraday high. The S&P 500 climbing up at one point to over 6,020. Right now looking at 6,004. Let's get over to Abigail Doolittle to tell us what stocks are moving right now. Abigail?
Well, one stock that's certainly participating in the rally, Robinhood Markets. And this has Morgan Stanley upgrade shares to an overweight from an equal weight. The analysts there saying that this company, this trading platform, is really going going to benefit from the Trump administration, into the Trump administration and through it on animal spirits. However, to the downside, let's take a look at MicroStrategy, the stock that had been up more than 600% on the year. Over the last 3 days, you can see a bit of a decline here, down 16%. This, of course, as Andrew Left of Hindenburg revealed a short position. It's not that he's bearish on Bitcoin. He actually is long Bitcoin, but his pair trades, his hedge to that is MicroStrategy and that big rally, valuation wild, and everybody forgetting they're actually a software company. And then finally, let's round it out with Supermicro on the day, up a very impressive 15.2% after last week, bringing on a new auditor, BDO, in addition, making a plan with NASDAQ to try to stay listed. Over the last 6 days, Katie, this stock up more than 100%, a massive relief rally. Big bearish short interest there of nearly 20%, so probably a lot of it is a short squeeze.
Yeah, we'll have to see, of course, how long that lasts. There's a lot of issues, question marks over at Supermicro, but at least for the day, like you said, up mightily. Abigail Doodle, thank you so much. Now coming up, it's the story of the morning. That is Macy's delaying its earnings report due to a single employee. More details next. This is Bloomberg.
Let's get out of high interest. Look what's making headlines around the world. In Germany, the Social Democrats backed current Chancellor Olaf Scholz as their lead candidate for February's snap election, even as he faces poor approval ratings. The news comes as ThyssenKrupp Steel announces it will cut 11,000 jobs between now and 2030. The move will further shrink a business that's lost billions of euros thanks to a global steel glut and rising energy prices. A pair of Minnesota birds are the two lucky turkeys who will escape a foul fate when President Joe Biden pardons them later today. Peach and Blossom were plucked for the presidential flock and went through rigorous training. Some of that training included an introduction to a variety of music, everything from polka to classic rock. In keeping with tradition, the birds enjoyed a night's stay at the Willard Intercontinental Hotel before their big day today. I can't believe all of that is true, but I'm sure it is. Macy's is delaying its third quarter earnings due to an investigation. The company says a single employee responsible for small package delivery expense accounting intentionally made erroneous entries to hide about $132 to $154 million of expenses. Macy's says the employee no longer works for the company. Katie?
Yeah, I can't get enough of this story. It is truly wild. So let's get into some of the details now with Mary Ross-Gilbert of Bloomberg Intelligence joining us from our LA bureau. So you had the distinct pleasure of waking up to this news and put it into context for us. When we think about these hidden expenses, what does it actually mean for Macy's business?
Yeah, so it was incredibly unfortunate to learn of this accounting error, this hidden expense. It's like you said, it's 132 to 154 million. It does cover a 3-year period, and it's a cumulative figure. So what this means is that the impact on earnings could be somewhere around 20 cents a share on average per year. So I think the way to really look at it is it does not impact cash. So that's the good news. But the bad news is what happened with the financial controls. And we're going to learn more when the investigation is complete. And of course, this caused a delay to their third quarter earnings. But there were some good news out of the third quarter earnings. One is their comparable sales on an owned plus licensed plus marketplace basis was down less than analysts expected. It was down 1.3%. And analysts were looking for that to be down 1.5%. So it was a tad better. And we think that's a good measure of the business. And we think the go-forward figures, and what that reflects is it excludes 150 stores that are slated to be closed over the next few years. And those figures show that comp sales were down 0.9% on the same basis. And so that's encouraging that the trends are better. And even better than that are the go-forward stores. These are the stores where they're adding back service into shoes, handbags, and ready-to-wear. And this is boosting sales. So their comp sales for those 50 stores that they've refreshed with better brands, merchandising, those were up 1.9%, and it's the third quarter of an increase. So it's showing signs that the management's plan is working. It just needs to happen across the rest of the go-forward store base under the Macy's nameplate. And then, of course, if you look at the luxury side of the business with Bloomingdale's, comp sales were up 3.2%, again on that same basis we mentioned earlier, and Bluemercury up 3.3% for the third quarter.
Why is, and I, admittedly don't know a lot about, I was going to say supermarkets, department stores, Mary Ross, but I'm looking at, the total market cap is less than $4.5 billion, and yet they're expected to show sales revenue of more than $22 billion this year. So why is this company trading at less than, 0.25 times sales?
Yeah, so that's a good question, Matt. And the reason for that is because the trends have been negative. If you look at the top line, they've lost market share. And who are they losing market share to? Likely to off-price and to a certain extent the mass merchandisers like the Walmart and Targets of the world, except for Target didn't have good earnings in the third quarter. Another thing to note about the third quarter is most apparel retailers are seeing weakness because there was unseasonable warm weather. Plus, we also had the impact of a few tropical storms and hurricanes in the quarter that also impacted sales for most companies. So one thing that Macy's noted is, guess what? November to date, our sales trends are better than they were in the third quarter. And this is something that we've been seeing across the board from retailers that are reporting.
Yeah, well, let's talk about that a little bit more. Bloomberg Television spoke to the CEO of Bloomingdale's. Let's take a listen to that now.
I really do think that actually the department store model has a bright future, but it has to reinvent itself from the perspective of the customer, but also from our brand partners. We have to be relevant for our brand partners and rethink the model from this point of view.
Now, I thought that was interesting for two reasons. He has the Wicked merch behind him, and that movie has just been so grossly overpromoted. That's one thing. But the second thing, which I want to ask you about, is this idea that the department store model needs to reinvent itself. I mean, you think about the competitive landscape right now. Do you agree with that?
Absolutely, Katie. That's been an issue for some time, right? Because if you look at the trends going back to the peak for department stores and sales was probably about 2015. And since then, there's been a decline. So you've seen a lot of store closures. You've seen exits from the market altogether. So it's clear that the model needs to evolve. So when you think about going into a big box operator, it's a destination type experience, and it's via the malls. So that means you have to park and you have to walk a long way. So how do you make yourself more relevant? So now the A+ malls are doing really well. And of course, Macy's locations in those better malls are doing better. So that's why they're going to be closing more stores, and thus the 150 slated for closure. So I think you need to have a smaller box. It needs to be highly relevant. And we've been seeing under Tony Spring, he was the former president of Bloomingdale's, and he's the one who really took Bloomingdale's and evolved it, bringing in all these new brands. And it's been a good performer for Macy's. And so now he's heading up the entire company. And I've seen the improvements in my channel checks at the stores here in Southern California. And I think it's improving, and there's still more to go. I see that, but I think there's possibilities to really reinvent the department store. And we're seeing some good news with Nordstrom. They seem to be executing better with their full line stores. Their boxes tend to be smaller. They have a lot less of those stores than of Macy's. And those stores are located in those better locations as well. So I think we're seeing better results there, and plus they're benefiting from having an off-price business, so they're gaining market share there. So that also helps.
All right, Mary Ross-Gilbert of Bloomberg Intelligence, really appreciate you joining us. Hope we can get you back because this is fascinating stuff. Still ahead, a Lululemon theft spree that really stretches the imagination. All the sordid details next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, soap and fragrance company Bath & Body Works is delivering an earnings beat and a positive outlook. The company said that investments made in marketing and technology combined with product innovations are resonating with new and existing customers. That's good for a 16% rally. Next up, Intel and the Commerce Department are said to be close to finalizing an $8 billion CHIPS Act grant. This grant would go a long way towards supporting its manufacturing expansion because, remember, the struggling chipmaker has tried to raise cash in recent quarters by selling off some assets and also faces a possible takeover from Qualcomm. And finally, it's sour grapes for a pair of Lululemon thieves. A Connecticut couple is charged with helping to steal nearly $1 million worth of Lululemon merchandise during a 2-month cross-country theft spree. The alleged thieves used various methods to steal the products, including distracting store employees, while the other person concealed the apparel under their clothes. That's according to the complaint. The next shopping trip may very well have them looking for prison garb. We'll continue to follow that story very closely. But coming up next, don't go anywhere. We have a great conversation coming up with H&R Block CEO Jeff Jones. This is Bloomberg.
H&R Block releasing its annual Outlook on American Life report. It found optimism is high across all income levels, but debt is a real threat to future prosperity. Here with more details is Jeff Jones, the CEO of H&R Block. Jeff, great to have you on the program, and truly fascinating report. A lot of things I thought were counterintuitive. For example, 2 out of every 3 people surveyed said they expect to have greater economic opportunities than their parents did. And yet, you know, a whole generation of people can't afford to buy a home. But your survey, you were just explaining to us, is very comprehensive. Tell us about how you did it.
Well, good morning, y'all. And I guess the first thing is remember that we're starting with actual data reported on anonymized tax returns. And then in addition to that, we're surveying 8,000 consumers across 4 generations. And so this is the 4th year we've done the report. And because it is actual tax return data, not just sentiment data, I think that's why it may paint a picture that might be a little counterintuitive about optimism, especially.
That's so interesting because we've been seeing that play out. It feels like across the economy for a while that the sentiment readings are miserable, and yet you take a look at what people are actually spending and they're earning, and it's a little bit different there. But talk to us, too, about the role that debt plays into this survey and what you're seeing there.
Absolutely. And to be clear, when we're asking people about optimism, it's not about necessarily right now or next week. I mean, the inflation pressures have been real on the consumer, but when they think about themselves versus prior generations, themselves versus their parents, that's where the optimism really kicks in. And debt is really the one big overhang. And we see that being credit card debt. We see it being student loan debt. Obviously, as a company, we're focused on helping people get the most financial outcomes they can and learn how to manage their money better. But debt really is the biggest overhang as we look in the next year and more.
I want to know about your business and the potential of artificial intelligence, because whenever I have been thinking about AI over the past few years, I instantly think of the tax code. It's so big and complicated and difficult to understand. Is this something where, I mean, have you trained your own model for this?
So we have a great partnership in our current use cases with OpenAI and Microsoft, and we're also bullish on what AI can do in our business, both for the consumer and for the thousands of tax professionals. Last year, we introduced what we called AI Tax Assist into our do-it-yourself software, and we saw consumers that engage with that product convert, meaning finish their return at a higher level. We've spent a lot of time since April improving that product. So, you know, this is a very long game, of course, but I'm really bullish about what we're seeing with AI in our consumer products and ultimately what it can mean to the productivity of our staff as well.
Yeah, it'll be fascinating to see that bear fruit. I do want to talk about 2025 and what could happen to your business, though, because you take a look last week on Tuesday, your stock had a big drop to the tune of about 8%. That's after there was some news about Musk and Vivek Ramaswamy basically thinking about creating this mobile app that would let people actually file their taxes on the app. There's been efforts, including from the IRS, to develop something like this. And you've seen that move sort of been shaken off. But how are you thinking about that? I mean, there could be a possibility that something like this actually happens. We're on the priority list when it comes to the Department of Government Efficiency is an unknown. But what could it possibly mean for H&R Block? And are you taking any steps for that possibility?
Great big question. I mean, obviously, the starting point for us is remembering that currently there are over 30 organizations that offer 100% free tax prep. We as a company offer free federal filing and free state filing, and most of that happens through an online product or app today. And so when I think about what the American consumer needs the most, they need a highly efficient and effective IRS. They need the phones to be answered. They need to know where the status of their refund. They need conflicts resolved. And so when we look at the market today, there are so many organizations already offering free tax prep apps. I really think the leverage is in helping the IRS do its job more efficiently and more effectively.
Yeah, I don't see a competent and efficient IRS anytime in our future, or a less convoluted tax code. I mean, isn't that where you can really take comfort that the way our system is set up just doesn't lead at all to simplification of the tax code? It's not in the interest of the people in Congress.
I mean, the thing that I've learned in this business, and keep in mind, we've been at this for 70 years as a company. I've been here for 7 years, is the American tax code by design is built to incentivize certain behaviors. Buy a home, get educated, have a family, get married. And so most people think so much about the deductions in the tax code, but for most Americans, it's really about these credits that incentivize them to pursue the American dream. It is complicated, especially when you factor in federal, state, city, or local in many cases. And so it is a complicated system, but it was designed to do something very specific. And so our job as a company is not to weigh into tax code, but we're helping the IRS administer the policy really by standing for the consumer and helping the consumer get everything they deserve at tax time.
Well, you could argue that the tax code is also set up so that people actually use services such as H&R Block because it is so cumbersome, it is so complicated. And with that being said, do you think that there's a certain price point where people might actually say, maybe I'll just do it myself, it's too expensive? How do you answer those sort of questions?
Yeah, it's not intuitive for a lot of people, but one of the most surprising things I've seen in our own business is the number of people who start as a DIY filer. They have confidence they can do it themselves. They start the process. The growth of people, the growth rate of people who are increasingly pushing the magic button and adding help to their own experience. And I love how we're positioned here because when that button is pushed, they can access AI tax assist and artificial intelligence, or they can access a live human for help. And so no matter how simple or complex the code is, what we've seen is it's a topic where people aren't confident. The outcome matters so much to Americans. Most are getting a refund. And so they want to ensure they're getting every single dollar they deserve. And that's really the role and value that H&R Block can play.
All right, Jeff, it's great to spend some time with you. That is Jeff Jones. He is the CEO of H&R Block. Meanwhile, let's get a check on these markets. A little over an hour into the U.S. trading day. Here's Abigail Doolittle.
We do have stocks higher after climbing again last week. Last week up more than 1%. I should say the week before that down. But then, of course, that big election rally continues. So today up about 0.4% off of the highs, but still a nice rally. And then with the Trump administration's Treasury Secretary pick underway, and the idea that there's going to be some relief around policies that they won't change too much. We can see that we have gold down, oil down, and then that 10-year yield, a real rally for bonds, down 11 basis points at that 10-year yield, now below 430. In fact, let's take a look at the S&P 500 dividend yield relative to the 10-year yield, and you can see that for a long time it really paid the S&P 500 dividend yield, but right now we are dipping into negative territory here. This, as the S&P 500 today has hit another intraday high. Let's take a look at some of the stocks that are contributing to these gains. And Supermicro Computer up 14% over the last 6 days, up more than 100% as they hired a new auditor, BDO USA, and they also are trying to make plans to stay listed on the NASDAQ by filing that delayed 10K. Robinhood upgraded over at B of A to an overweight, or excuse me, Morgan Stanley to an overweight on animal spirits and other benefits of the election. Meta Platform higher, they were added to Ray J's favorites list. And then rounding it out, I should say, Matt, we have Amazon.com here up about 1.5%. And apparently they're going to take on NVIDIA with some of the data chip business. So that could be an interesting one to watch as time goes on.
Yeah, I think, they have been, and it's that competition has been highlighted in our big take. I highly recommend Bloomberg Terminal subscribers check it out, or anyone with internet access. Just type Bloomberg.com to see that story. Abigail Doolittle, thanks very much for that. Coming up from Oz to the Coliseum, it was one of the busiest movie-going weekends of the year. We've got the box office scorecard next. This is Bloomberg.
Bring folks together is to give them a real good now I will control.
It was a strong start to the holiday season for the box office. Wicked and Gladiator 2 brought in a combined $170 million in the U.S. and Canada. Joining us now is Kevin Neer, who leads movie theater coverage for us at Bloomberg Intelligence. Kevin, I was at the theaters, as were very many people. I couldn't believe how long the lines were for Wicked and Gladiator 2. But these movies were heavily invested in terms of production costs and marketing.
That's right, Matt. Big bet on a big movie, and they delivered, both of them. Now, coming into the weekend, both had very, very high expectations. They were a little bit light of those, but I don't want to mince words. Really, really great attendance at the theaters this weekend.
I want to talk about Wicked in particular. I know that you saw Gladiator 2. Did you dress up?
No. I dressed down.
Okay.
Just a belt.
So I can't speak as much to Gladiator 2. I haven't seen Wicked yet, but I feel like I've seen it because this movie has been in production for so long. It's been talked about for so long. There's clips all over social media. I mean, you think about just the machine that went into Wicked.
That's right.
When's the last time we saw something like that?
It's tough to say. I mean, for Universal, they as you're saying, they have a lot of faith in this movie. They have a part 2 coming out next year. But the marketing, I mean, it's no surprise that this movie's coming out around the holiday season, right? So they're thinking about merchandise sales. They're thinking about their theme park and really driving up that revenue. They don't have to split the merchandise sales with the movie theater like they do with the
there's
tickets.
like a Wicked product for everything at this point,
Might
which
be.
is just amazing. I watched a Lexus/Wicked commercial, so maybe there's a Wicked car out there. But you think about some of the hype going into the fact that we have Wicked and Gladiator 2. Some people were calling it Glicked, trying to compete with Barbie and Oppenheimer last summer. I mean, that Barbenheimer was enormously successful. Is there a chance that Glicked actually surpasses it?
Not quite. It was a little bit shy. We didn't see quite as much organic buzz that Barbenheimer got on social media. But still, third highest attendance weekend for theaters this year. AMC just came out this morning, said it was their best pre-Thanksgiving weekend ever. So really, really strong. No doubt about it.
All right. Well, I recommend you see Gladiator 2.
Yeah, I don't know. It's
in the theater. I know
Paul
you won't.
Mescal. I hear he's a vision in it, but in any case.
He's like Lawrence of Arabia. I mean, the guy's like a classic Hollywood actor. It looked like a 40s picture. It was very good. Kevin, thanks so much for joining. Kevin Neer there from Bloomberg Intelligence. Now, the Formula One Grand Prix wrapped up in Las Vegas over the weekend. Bloomberg's Hannah Elliott was there on the ground, and she joins us now. I guess first with a wrap of the race, Hannah, it's been, it's grown so much in America because of Drive to Survive, and now we're talking about something that captures maybe even 1 billion eyeballs on certain weekends. How was the race in Vegas?
The race was, as you can imagine, wild and crazy. This is year 2 for Formula One in Vegas. And you know what? Sales were a little bit down. Everyone I spoke with at hotels and shops, taxi drivers, servers, they all kind of said, hey, year 2, sophomore year, everything's a little bit down from this first year hype that we saw. But let's not forget, this is Vegas. Vegas is never, ever going to disappoint. At the end of the day, there was a sold-out crowd. More than 300,000 people reported over the weekend to see the race. And not the most exciting race. However, it was exciting for George Russell, who won, and Lewis Hamilton, who got second. He moved himself all the way up from 10th to second. And then, of course, Max Verstappen clinched his 4th Drivers' Championship. So all in all, very exciting race.
All right, we talk about this race in F1 on our podcast as well. For those inclined to listen, it's called Hot Pursuit, and you can get it on Bloomberg.com or Spotify or wherever you get your podcasts. I also want to point out that we have 2 of the world's most significant classic cars going up for auction, and this is something we focus, I think, even more on in Hot Pursuit, hence the title. Tell us about the Mercedes Streamliner.
So this, you know, if you listen to Aram Sotheby's, this perhaps is the most significant, very, very early Formula One race style car that has been up for sale since the Uhlenhaut Coupe that sold for $142 million in 2022. They're basically saying this car is just as special. It will be sold in a private sale in Stuttgart in February, and it's actually owned by the Indy Museum. The Indy Museum is selling off 11 cars to raise money. Aram Sotheby's is doing all of the sales. And
wait, did you?
I think we
Premier
did
sale.
Sorry, we lost you for a moment. We're looking at that Streamliner, the Indy car. We're also looking at this 1965 Ferrari 250 LM. What's the significance of the Ferrari?
The Ferrari, I don't know if you've heard of NART Racing, North American race team racing. This car is a championship NART car. And again, one of the most significant Ferraris. It's going to be sold at Retromobile next year in Paris.
All right, very cool. Hannah, thanks so much for joining us. Hannah Elliott there. And do be sure to check out our podcast, Hot Pursuit. We put it out every week on the Bloomberg Terminal, on Spotify and Apple Podcasts.
I didn't know you had a podcast. You never mention it.
Have you also got a podcast?
You know,
Katie
I do,
Greifeld?
and we never talk about it. I do have a podcast. It's with my other Matt Levine. I have TV Matt, and then I have podcast Matt. Matt Levine, of course, of the Money Stuff column. We have a podcast called Money Stuff. I don't think we've ever talked about cars on it, though.
Never?
Well, sometimes I talk about me driving. It's a really great podcast. If you read the Money Stuff column, you'll probably like it.
Yeah, I do like it, actually.
Yeah.
I listen to your podcast.
We got to get a graphic for it, but in any case.
Coming up, Wall Street welcomes one of its own as Treasury Secretary. More on Scott Bessent's appointment next. They'll talk about that in Money Stuff. This is Bloomberg.
All right, Scott Bessent, he is the hedge fund boss who's been picked to lead the Treasury in President-elect Donald Trump's next administration. He has 2 words for you: economic lollapalooza. The Key Square CEO sees a coming global economic reordering and has wanted to be a part of it. Joining us now is Kayleigh Lyons, co-host of Balance of Power in Washington. We finally got this news on Friday night. I know that you broke it on air, and it's interesting that it took this long, but we have some details. Yeah. Now, talk to us about the 3-arrow policy that he seems to be championing.
Yeah, that's just really what he wants to achieve, Katie, or at least what he has pitched to the president-elect. This idea that he would like to cut the deficit to 3% from the current 6% by 2028. He would like to see GDP growth rise to 3%, and he would like oil companies to be pumping 3 million more barrels per day, the 333 policy. But the problem is the Treasury Secretary, which he has, of course, been appointed or nominated to be, he still will need to be confirmed by the Senate, only has so much power in actually making those things happen. For example, Congress has the power of the purse. They will actually define the budget, the appropriations process of how money gets spent within the U.S. government. And they also will control tax policy, which is a key element of what Bessent says is going to get us to that 3% GDP growth. He told me as much when we talked to him last here in our Washington, D.C. studio. It is higher growth from taxes that will help offset the cost in addition to tariffs. But there's also a question here as to what extent he as Treasury Secretary would really be the formative voice in shaping that tariff policy. Is the man he was jockeying with for this position, Howard Lutnick, who Trump nominated to be Commerce Secretary, Trump says is going to have authority over trade and tariff policy. So we do have some remaining questions as to how these two exactly are going to work together, how Bessent will be working with Congress to try to get his economic policy objectives actually achieved. But by and large, and you can tell by the market reaction today, he is seen as a more steady hand, someone who literally has a macro mind and will be cognizant of the way in which policy could impact financial markets. And we have to keep in mind Elon Musk, who wasn't in favor of Bessent being named Treasury Secretary, said that was because he's the business as usual choice. But we know markets tend to like predictability and things staying as usual.
Absolutely. I mean, Ken Griffin wants the Trump administration to be about getting back to business, the business of business. There's some contradictions here, Kayleigh, in that Scott Bessent wrote an op-ed, I believe, for the Journal when Donald Trump was elected and pointed out that the president powered the biggest rally we've seen in the dollar in 2 years. And yet today we're saying the dollar is down because of Bessent as a pick. Also, we hyped Scott Bessent as the speechwriter for Donald Trump's beautiful tariff speeches, you know, like the one he gave at the Economic Club of New York. And today we're saying that the market is taking solace in the fact that he's not so pro-tariff as his future boss, Donald Trump. What do we actually know about where he sits on these issues?
Well, he is pretty aligned with the president-elect when it comes to these policies. He has advocated for the use of tariffs as a means to offset any lost revenue from the tax cuts, which, again, he would like to pursue. He wants to see those 2017 tax cuts made permanent. He thinks that will help overall GDP growth. That said, he may not be as much of a blanket yes to Donald Trump's policies as maybe other choices could have been. And it's worth keeping in mind as well that we knew Bessent was in the mix for a very long time. So I do wonder how the market hadn't already kind of priced in this selection, at least to a certain degree, because he was always on the short list. Donald Trump essentially ended this Treasury search pretty much right where he started it in selecting Scott Bessent. That said, some within the Trump camp who were a little reluctant to see his name ultimately the one selected are because they are worried that he might not necessarily be as adamantly America first as others, including the president-elect himself, are, keeping in mind, of course, that he will be cognizant of financial market reaction as he does have this macro backdrop, which really does look at not just domestic but geopolitical risk as well. And that is likely to inform the advice he gives the president-elect.
Right.
But again, the Treasury Secretary only has so much power in advising and trying to execute policy once it's written, but other people have roles in this as well.
All right, Kayleigh, got to leave it there. That is Balance of Power co-host Kayleigh Lines in Washington. And like she said, big reaction in markets right now, particularly in the bond market, to that selection of Scott Bessent. Finally, when it comes to Treasury Secretary. Coming up tomorrow on Open Interest, we'll speak to Neil Dutta of Renaissance Macro. He joins ahead of the Fed minutes. This is Bloomberg.